Tom Gentile. Welcome to Tom's Trading Room. And before we begin today's video on crappy trades, if you could show us some love and give us a thumbs up down at the bottom of the screen and like this video, that actually helps support the channel. Subscribe and ding the bell, and you'll be notified every time a new video comes up. All right, let's get started. So, crappy trades. When you look up the word crap in the dictionary, you get excrement, defecate, but you also get something of extremely poor quality. What I'm talking about are options that are way overpriced. All right, so we want to take those overpriced options and sell them in a limited risk way to where we have a high probability trade, which also means we have a high probability of profit. So, Mike Wade, take it away.
Hello, this is Mike Wade, Chief Option Strategist for Tom Gentile and Tom's Trading Room, and welcome to this video. Are you somebody who feels like whenever you place a trade it goes wrong, that you just seem to find all these crappy trades? Everybody goes through that from time to time, and some people actually think that if they pick a trade it's going to lose. Well, if you're one of those people, I've got a system for you, and I'm going to call this selling crappy trades high probability short-term profits. So the idea here is that we're going to find the worst possible trade that we can find and then sell it to somebody else. That's the basic theory. Similar to calendar spreads, this is a sunrise strategy that profits on time decay, on the passage of time as the sun comes up each day. That's a good thing for these crappy trades. So in this sunrise series, I'm going to be talking about the Greeks, and I want to continue to refresh the concepts so that you really understand what the Greeks are all about. Once again, the Greeks are nothing but sensitivities. They measure your positions, sensitivity to direction, that's stock price movement, fluctuations in implied volatility, and the passage of time. The Greeks that measure your position sensitivity to direction, implied volatility, and time decay are Delta, Vega, and Theta, respectively. Strategies that profit with the passage of time are called Theta positive strategies. Iron condors, calendar spreads that I spoke about in my last video, butterflies, and in this video we're going to be talking about credit spreads. So what exactly is a credit spread and how can we use it to profit with high probability as the sun rises? Let's just hop right in with a case study. This is a case study I did recently on Apple Computer, and I want to start with some very basic, simple technical analysis and emphasize the power of support, resistance, and volume. This is the cornerstone for this system that routinely and easily identifies opportunities for us for this crappy trade system. Here's a chart of Apple Computer on August the 21st, 2020. And what I want to point out to start with is this thing called support and resistance. So check this out. 480, that's a round number. And Apple on this particular day, on August 21st, 2020, busted above 480 that was prior resistance, and it was an all-time high. So Apple hadn't been at 480 before, split adjusted. So how do I know that was a resistance level? Well, check this out. If I draw a line at every 20 points on the Apple chart, notice how often there are turning points at these even $10, $20 increments. Just take a look at the number of turning points and bounces off of these 20-point increments. Right here at 320, lots of bounces off 320. We get a resistance stop right there. The stock finds support at 360, then goes right back up to 380. 380 provides a really nice level of support. And then the stock breaks down through 380 and then all the way down to the next support level at 360. We get a bounce there. The stock bounces up to 380, bounces off that for 3 days, then breaks through once and twice and 3 times, and then finds resistance at 440, which becomes support once the stock breaks above. And then after bouncing a few times, the stock takes a run up to 460, finds resistance at 460, rests there, ultimately breaks through resistance up to 480, and then beyond 480. So nothing is foolproof, and neither is support and resistance, but it's really a nice indicator where you can predict not only where the stock might go next, but also where it's not likely to go. So right here you can see that after we broke above 480, there's support there. That's a line in the sand that should keep the stock propped up above that level. Now, when you couple it with a volume spike, as you can see here, the volume on this particular day spiked up a lot higher than average, suggesting there's a lot of institutional conviction behind the move. When doing support, resistance, and volume analysis, consider volume institutional conviction. Remember, institutions control 75-85% of the market. They control most of the market, and therefore they have most of the volume. So what I could say on this day is that institutions propelled Apple well above 480 resistance, which is now support on above average conviction. So my prognosis at this point was that Apple was going to rise from here and certainly stay above 480. All right, so now for the fun part. Let's find the crappiest trade possible. Given this bullish prognosis, what could I do to lose money the most efficiently? And for some of you, that might mean just keep on doing what you're doing right now. But we're going to flip the battery in backwards, and we're going to take that prowess that you might have in finding crappy trades, and we're going to flip it around and give you exceptional probability. So here's a crappy trade. Given our bullish prognosis that this stock's probably going to go up from here, lots of conviction on this move up. Apple's going up. That's my prognosis. And I certainly don't think it's going to drop below 480. That's a solid support level. Here's what we could do to lose money. Why don't we buy a put at 480? So obviously a put requires the stock to drop for us to make money. And to make it the crappiest possible, we're going to only use a 7-day option. So this option will expire within 7 days. And if the stock stays where it is or even drops a little bit by that point in 7 days, this option will be worthless. Why on earth would you ever do something like that if you were bullish on the stock? And remember, when you buy a 7-day option, your theta is magnified. Theta is huge. Each day, you're bleeding money by buying a 7-day out-of-the-money 480 put in this case. Let's take a look at the Greeks on a crappy long put trade. Remember, a long put gives you the right to sell the stock, in this case Apple, at 480 until August 28th. Remember, it's August the 21st. This right's going to cost us $5 per share controlled, and that's going to be 100 shares controlled, so that's $500 entry debit. That is also our maximum risk. Let's take a look at the Greeks. We'll review the Greeks a little bit. I'm going to keep doing the Greeks with you in the next handful of videos so you really get these things. And remember, they're really simple. No big deal really whatsoever. So remember, our prognosis is bullish. So a negative 26.46 means that we need the stock to drop in order to make money on direction. If the stock goes up $1 in this case, we're going to lose $26.46, and that just gets worse and worse with every dollar the stock rises. Vega is also positive, which means the position would prefer implied volatility to rise, and if Apple rises as expected, the implied volatility is most likely to drop, which means we're going to lose money on implied volatility dropping over the next 7 days. And of course, theta is negative, and it's a big negative, negative $69. That means by tomorrow, this trade will lose $69 on theta. This thing's losing everywhere. Delta's wrong, Vega's wrong, theta's wrong. This is a decidedly crappy trade. Now, fortunately, in the options market, there's always a buyer for every seller and a seller for every buyer. Our market makers ensure that's the case. Let's take a look at the other side. So instead of buying this crappy trade, what would it look like for us if we were to sell it to another? Let's take a look. If we sell this crappy trade, we're going to sell the August 28 480 put for $5, same price. Now that's going to give us an obligation to buy the shares at 480. And provided the stock stays at 480 or above, this whole thing will expire worthless on August the 28th. That's where your probability comes from. Remember, 480 is a support level. We're expecting Apple to be above 480 in 7 days. So that's going to give us a credit of $500 in this trade. That's the most we can make. That's our max profit. I'll come back to max risk in a minute because that's scary. We got to talk about that. But let's look at our Greeks. Are our Greeks lined up? Let's see. We're bullish. Stock price is rising. Delta says, yes, that's good for us. We make $26.46. If the stock does in fact rise, implied volatility is most likely to drop. For every percentage point that it drops, Vega is telling us we're going to make $22.54. That's good too. And of course, we have our sunrise Greek theta that's positive 69.44. With every day that passes, that number will get bigger. We'll make more and more money as the sun comes up each day. Again, comparing long versus short, you can see the Greeks are the exact mirror opposites of each other. We flip the battery in backwards. This is the crappy trade. If you buy it, this is the crappy trade if you sell it. So let's take a look at something. Here it is again. This is our crappy trade. We're going to sell this trade for $500. Our Greeks are beautiful. Our theta, our sunrise theta is at 69.44. We love that. But there's a big but. We have a $47,500 maximum risk. So if Apple were to tank for some reason, you've got a lot of risk on the line. So we need to protect that. And similar to a calendar spread, we're going to buy something to protect, but in this case, we're going to buy a lower strike option. So here's an Apple short put spread. This is notice we're still selling the 480 put for $5, and we're protecting ourselves by buying the underlying 475 put. So that 475 put gives us the right to sell the stock at 475, and that covers our obligation to buy the stock at 480. This insurance policy, this 475 long put, protects us in the event the stock tanks. So for example, if Apple was trading at 400 tomorrow, we'd end up having to buy the shares at 480, but we could certainly turn around and sell them for 475. That would be a $5 loss. However, we took in this case, $125 per credit spread, giving us a $375 maximum risk. Notice this 125 is the difference between our credit of 5 minus our debit of 375, netting a net credit of 125. Again, max risk 375. You want to make sure you position size your credit spreads right here. So if you had a $500 max risk, you would only do one of these. If you had a $1,000 max risk, you could probably do around 3 of them. Again, entry credit 125, maximum risk 375. A potential profit of 33.33% over the next 7 days, and our beautiful positive Theta sunrise Greek is in motion. We still have our positive 7.28. We still have positive Delta, which is good. We still have negative Vega, which is good. So this trade is making money all 3 ways: direction, implied volatility, and time. When you're aligning your 3-part prognosis to Delta, Vega, and Theta, your trading will reach a whole new level. All right, so this is a short put spread risk graph. Stock chart on the left, risk graph on the right. Here's our profit, potential profit in the trade. Here's our potential risk. This is something to note. We're going to take less credit, in this case $125, and we're going to risk $375, which is a 1-to-3 reward to risk ratio. And the only reason we would do that is because of probability. This is a 7-day trade, and as long as the stock stays where it is, goes up, or stays above this blue line, that's our profit zone. And the probability of that happening in this particular case was around 80+% or so. Again, stock goes sideways. Over time, these colored lines will move towards maximum profit, which is right here at $125 of maximum profit. So as time happens, from 7 days to 5 days to 3 days to 0 days, tick, 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 we make money. That's where our positive Theta kicks in. Also, as implied volatility comes out, these colored lines will also be moved towards maximum profit. So let's see how this trade actually came down. I'll advance it a day at a time. The next day the stock went up. You can see the intersection of the blue line, this horizontal blue line with the red line. That is our current profit in the trade. We have 4 days left. The next day, 3 days left. There's our profit. You can see as we approach expiration, there's more and more profit. There's $100 of profit on that day. There's $110 or $105 of profit on that day. 1 day to go, August 28th, expiration day. This spread expires worthless for a maximum profit of 33.33% over 7 days. The power of probability, the power of selling credit spreads that are out of the money, in this case, at a support level that was not likely to be breached. This is very, very smart trading indeed. Here are the basic crappy trade credit spread entry rules. I've just demonstrated the bullish aspect. Well, I'll show you the bearish one here in just a few minutes. I've got a case study for you. But you want to look for a stock close beyond support and resistance. You want the volume to be greater than yesterday, preferably above average. And then once you have those conditions, the support, resistance, and volume conditions present, you want to sell a credit spread. And if you're bullish, a bull put credit spread at or beneath support. And for a bear call credit spread, you want to sell at or above resistance. Make sure to use 7 to 14 day options. Use consecutive strikes. That could be as small as 50 cents, $1, $2, $5, $10, $20, but use consecutive strikes. So buy and sell using strikes that are right next to each other. And what that does for you is give you the highest potential return on investment. Make sure to give yourself a decent maximum return on investment of at least 20% or even 30%. I wouldn't go too much higher than that. If you do get higher than 30%, I would suggest moving your credit spread further away from the stock price and take less for additional probability of profit. Let me make sure you're exactly clear on how to construct a bull put spread and a bear call spread. A bull put spread, this is the opposite of a long put spread. So you sell the higher strike put and you buy the lower strike put. Again, use consecutive strikes for maximum return on investment. A bear call spread is you sell the lower strike call and you buy the higher strike call. Do the bull put spread at or beneath support, and do the bear call spread at or above resistance. And now for the most important part, how do you get out of these things? Well, first let's talk about taking our spread off for a profit. Now remember, you're selling the spread, in this case on Apple, we sold the spread for $1. And over time, if the stock stays above the short put, the spread will reduce in value. So you're going to get to a point where you're waiting around for maybe 5 or 10 cents, and it just doesn't make sense to sit there and wait for just a small amount of additional profit. And while you're waiting, the stock could certainly move against you. So one of the rules that we like to use is when you can buy the spread back for 10% of what you originally sold it for. So in our case, if we sold the spread for $1 and we were able to buy it back for 10 cents, we would net 90 cents or 90% of our maximum profit on the trade. So that's a prudent thing to do. Take the trade off the table, free up your margin, and go find another opportunity. Now this is the most important part. Because we're taking on less credit and a lot more potential risk than our entry credit, it's really important that you take these things off in the event the stock starts to move the wrong way. So for a short put spread, remember, we need the stock to stay above the short strike. If the stock closes beneath the lower break even, that's this light blue line that you can see there, then you exit the trade. Now here's the good news. If you do it, provided there's not a big gap down, if you do that, notice here that your managed risk in the trade should be right around here, which is about $125, which is equal to your original credit. So what I'm saying is, if you exit with a close beyond the break even, your managed risk will be roughly the same as your potential credit. So your managed reward to risk ratio is 1-to-1. On the bearish side, it's the same thing. If the stock closes above the upper break even, it's time to exit. In this case, if that were to happen, notice again, our managed risk is going to be somewhere in the same area as our entry credit. In this case, slightly higher. Whatever you do, you don't want the stock up in this max risk area. And note this, that it is possible sometimes you get gaps, but in the event you follow my technical analysis system of support, resistance, and volume, the likelihood of that is muted. So in summary, these are the credit spread exit rules for a profit stop. Buy back your spread for 10% of the original credit. Put that on as a good till cancel order so that the instant it happens, the instant it's available, your trade is automatically taken off and closed for 90% of your maximum credit on the trade. For a bull put, if the stock closes less than the break even, you want to exit the trade. And then for a bear call, if the stock closes above the break even, exit the trade for a managed reasonable loss. So to demonstrate selling a bearish crappy trade, I want to leave you with a current case study on the triple Qs. This is the ETF that tracks the NASDAQ. And over the last handful of trading days, you can see that the NASDAQ really broke down Thursday and Friday of last week, and then again on Tuesday of this week over the Labor Day weekend. And what's really interesting is you can see here that back on this day here, and what's really interesting is during the first breakdown day, the Qs crashed beneath 290 support and did so on above average conviction or volume. And then the next day, another down day, and then the next day, another down day. 3 big down conviction days. Lots of down volume on these 3 days. Since the NASDAQ has popped back up a little bit, but notice that the volume has declined. So there's no power behind this. It's unlikely that the NASDAQ will get above this resistance line anytime soon. So the prognosis is NASDAQ, the Qs will stay below 290. So let's find the crappiest trade. How could we lose money the most efficiently? Well, here's an idea. What if we bought a long call spread? We bought the 290 call and we sold the 291 call above. That's a bullish trade. That needs the Qs to rise in order for us to make money. And given this is a short-term trade, it's got to happen fast. So that's a crappy trade. We're going to lose money on that if we were to buy it. So what do? We flip the battery in backwards and we sell it. So instead of buying the 290 and selling the 291, we're going to sell the 290 and buy the 291. There you have it. There's a crappy trade that makes money anywhere below 290. So let me show you what that risk graph looks like. I'm going to hop into Tom's Tools and we're going to take a look. This is a 15-day trade. We're selling the September 25 290 calls. Again, we're doing this on the Qs. We're selling the September 25 290 calls we're buying the September 25 291 calls, and we're going to do that for a net credit of 30 cents, good till cancel. Now, this is really important. You want to make sure that you keep your maximum risk contained. For example, if you had a $500 maximum risk profile, the most I could do and keep my maximum risk under 500 would be to do 7 contracts. So I'm going to do 7 contracts on this trade. Click my risk graph button. And now we're looking at a $500 trade. We're going to make $210, 42.86% over the next 15 days. And we'll keep that provided the Qs stay below 290, which is very likely indeed. Our Greeks are lined up nicely. Here's a nice theta number of 620. We're making $6.20 a day. That number will increase as we get closer to expiration. Here's the beautiful risk graph. Notice here, the Qs are well beneath this 290 level. In fact, this trade is offering us a probability of profit of just shy of 74%. That's actually higher when you consider that 290 is resistance and should repel the stock in the event that it makes a run up to that level. So once again, here's the trade. Sell the QQQ September 25 290 call, buy the September 25 291 call for a credit of 30 cents, good till cancel. Again, position size accordingly. Welcome to one of my favorite strategies, the strategy of selling crappy trades, profiting with super high probability of profit in a matter of days. All right, I hope you enjoyed that video, and stay tuned for the next sunrise strategy I'll be covering next time, and I'll see you next time.